Welcome to Accounting 2302. Yes, 2302 coming live to you on Sanjak Radio with your host, Professor Naragon. Now, I'm going to go through how to get to your notes as we're going to go over chapter 14 today and be able to learn the basics of managerial, the introduction to it, so that you'll be ready to go. So, you do need to go to course content and go to lecture notes. You would love to go to homework assignments when you need going to do any of your homework, but you got to make sure you are registered with Connect before you can start those. There's two ways. You can go ahead and click the link. It's going to ask you to register. That's in the syllabus, or you can go through the homework assignments. They should actually give you the link also. But we're going to click the lecture notes file, and we're going to go to chapter 14. It will automatically download in the web browser for you, so you can do a lovely print of it, or you can actually download it yourself, which again, it just means it opens up in a new window. Yay for PDFs. So, chapter 14. Let's dive into it. Basically, what is the managerial accounting? Why does it differ? Alright, so if you're from 2301, you know we had to deal with a lot of external forces, external users, and that included basically our customers, our investors, anybody that's outside the government. So we were mostly focused on doing financial statements. Here, we are now focusing on the internal. What are our managers, employers, anybody that's actually working for the company that will basically make decisions. So, I want to zoom in, and you actually have the definition right here. Managerial accounting provides financial and non-financial information to the organization managers. It's all about decision making. That's the biggest key that we have going on here. So, right here, I love this graphic. Good thing right here, because you know there's probably going to be certain things that you're going to get asked for on a test or a quiz pretty easily right here. Big things is users and decision makers. Again, external for financial, internal for managerial. The purpose of this information, again, it's basically for managerial, because I want to focus on this side more, is again for managers to make decisions. They have to make the tough decisions based on us accountants. So we could be part of the big part that actually tells if a company needs to let go of something. So hopefully you get some thick skin, because if you get into this field, you gotta realize you're gonna probably have to cut jobs a lot if the company needs to. And it's your job to be honest. That needs to be cut. The flexibility of reporting, the cool thing is we don't have any gap constraints. We are not ruled by gap under managerial because these documents are not going outside the company. Unless it's corporate espionage, and then that's fraud, and then we're in trouble. But we don't have to follow gap, so there's going to be certain things that look a little bit different than our financial statements and how we prepare them. So we can do it any way that we would actually do to get the point across. Timeless, we need to have it really available quickly. We don't have to wait for an audit. It's straight to the managers, lets everything know. The dimensions, of course, they have to be future. They're obviously going to be about projections, and I especially tell you in the later chapters, we're going to do a lot of projections. Okay, we're doing budgets. We're going to be going through a lot of stuff to try and help our clients, okay, to help our managers. The focus of the information is usually on projects, processes, divisions. Again, should we accept doing business here? Do we need to decrease direct materials? They're all stuff that all on decision base. And of course, it's mostly monetary. While financial, you see, it's monetary information, they're financial statements. This is mostly monetary, but we do have a lot of non-monetary information, basically explaining what's going on. So this is a cool graphic. I will definitely go through here. And when you see, again, we need to do 3 very important things that are critical that we'll end up finding out, which is of course cost. Is this cost benefit? We have to plan for future, and we gotta find the actual results to plan results. Now this is really us comparing what we budget to what really happened, and why did one thing do better than what we actually budgeted. So we may have gotten lucky, got a better contract, or something else ended up happening. So how do we gather this information? Well, we have to actually determine the profitability of the item, business overall. So managers have to understand any related cost, activities, and the operational results. With certain divisions, some of them will have things together. So we actually have to eliminate which ones are not supposed to be together. And then we also have to kind of make sure we have our fixed and variables. So the managers know this division, the ones that they can control, actually are their fault. So the manager's got to blame the manager on certain aspects. Again, it's all about who has the control over this certain division or inventory, stuff like that. So we're going to look at basically how can we effectively analyze and help control costs. So this course is basically an introduction to another course that's offered in cost accounting. Cost accounting goes into so much more depth. It is crazy. So here we go. Graphic. It's a big old circle of managerial accounting. Almost. One, we have planning. Then we have control, feedback, monitoring, blah, blah. And it keeps going on and on. Mostly planning. We do set goals. We want to make goals that we can achieve. Always go a little bit realistically, but you want to see if you can do it. Normally these are established about 5 to 10 years out, but they do want to achieve some kind of short-term strategy. So quantifiable goals, just like our New Year's resolutions. If we want to lose weight, let's start with something small. Instead of saying I want to lose 50 pounds or 70 pounds, you probably want to go like, I want to lose at least 5 pounds, or I want to lose a pound at least this week. You want to keep working until you reach your goals. Well, the same thing here. These are short-term strategies, but quantifiable. So we want to actually be able to achieve these goals and see how they react. Now, sometimes it's good, sometimes it's bad. I mean, we may be entering a new product or service in the market. We just want to see if it can make it to this goal. If it can, cool. We want to keep it going. If it can't, then we want to get rid of it. You're trying not to go too heavily involved. It's kind of like expanding too many franchises, like Subway. They expand too quickly, now they have to cut back. That's not good. Bad, basically, short-term plan there. Now, also, like it says, building new factories or retail stores. If we're finding out that the strategy is that we are going to increase productivity by so much, We may want to build a new factory, kind of like schools. If a school is getting so many new students and it's increasing, they may plan to build a new school. That's one of the things here. We are planning it out and seeing if we need to do this to achieve goals. Next part is control. This is basically us accountants really going. So each one of these can be a position for us. We can either plan or we can actually control. Most likely we're going to be controllers a lot of times. So we're going to look at the decisions that our managers have made, because basically they're planning that we get control costs. So the control, we look at the planned decisions and we evaluate everything that's going on. So we're going to see, as the process goes, are costs too high? Can we reduce them? Are our services actually being profitable? If they're not being profitable and it doesn't look like they're ever going to be, why did we keep them? Are customers satisfied with our offerings? Now, those of course are more what surveys, more to see how it goes. But honestly, if you're doing a product and it's not flying off the shelves and it's taking so long that a turtle can beat it in a race, you may want to look at it. Okay? Anyway, so essentially they are decisions that are made, they're monitoring activities, and they perform and then evaluate using controlled decisions. So during the planning process, during all this, we have these certain goals. We want to see if they're making. If not, we're going to give feedback. And these feedbacks help adjust. So once we adjust, we'll have new little goals and we'll want to see if it makes sense. So kind of like McDonald's with their breakfast menu. They found out that certain things are not being bought like they should, so they're going to make it exclusive to the mornings to help increase those products. That's how it goes. Well, with all this, we have to come back to probably the most understanding thing of managerial accounting. Basis. Do not commit crimes. Fraud. Fraud is here, and there is ethical decision making. Why is there ethical decision making? Because you're planning. You want to make sure you release a product that helps people or makes the company money, but not for bad reasons. Okay? You want to make sure you're in the effectiveness for the employees. You don't want to have unethical behavior. So again, fraud triangle is right here. Nice little one. So if you remember this from 2301, it's back for 2302. It's going to be back for any other accounting courses, any business courses, because it's forever. Triangle is over here. And again, tell you this, watch a good show called American Greed, and this will actually tell you a lot about ethical behaviors. Or go find the documentary about Enron. You're going to find out a lot of stuff. But again, three sides of the triangle is rationalization. So again, we have to rationalize our decisions to make it that happen. Pressure, have Greedo come after us because we didn't pay our loan shark. So you may want to actually make sure we don't have any pressures. Again, opportunity. Accountants are always going to have the opportunity to make unethical activities. We always have access to nearly everything. So make sure that you're always going to do the right thing. Again, I don't want to see any of y'all in jail. Believe me, I think you're better than that. Because you're in college, you're learning all this. Just don't learn it for the wrong reasons. Okay? But managers can also do this. Managers are in a high position. They can also rationalize, be the pressure, and have the opportunity to commit certain things that shouldn't do. Problem with fraud. So, fraud, they hurt. So, basically, with a lot of this unethical stuff, but it hurts the organization a lot more. and it can be very, very costly to any organization. Not even loss of revenues. It could cause increased expenses because we gotta go get internal controls. We gotta get those security cameras. We gotta make y'all wear badges because we got ID y'all. But the biggest thing that can hurt is any fraud will hurt the reputation of the organization. Goodwill is the big key. If the company doesn't have any goodwill, customers will go away. And that's the worst thing for an organization and could basically lead to its demise. Look at Enron, WorldCom. Even newer companies like Quest Communications. All of them. They didn't do well. They committed all this stuff. Even mayors. You ain't gonna have too much reputation if you committed fraud as a mayor. You definitely ain't gonna get hired anymore. So, really, you gotta watch out on that. Because as soon as you commit it, they're gonna get rid of you. So, cool little act here. If you're an awesome accountant, which if you're going to that field, I know you're going to be, there is a certain act called the Whistleblowers Act that protects you from losing your job in case you find fraud from higher management and you actually basically whistleblow, tattletale on it. You're actually pretty much good, and mostly the SEC would love you to do that if you're in a public corporation. That way they can keep safe the stockholders and the reputation of the business. And believe me, if it's some manager inside that even the CEO or CFO doesn't know, they will love you for that because it helps their reputation. So, biggest thing to try to help prevent or limit are internal controls. So, they establish a lot. This includes that separation of duties, having security cameras, make sure you log in with a special password, fingerprints, eye rectal scans, anything and everything to help combat this. Best way also is that there is a code of ethics that we are maintaining to actually uphold. It's in the culture of a business. It's in the culture of the professional. So, professional accountants, we have our code of ethics that we believe in. The mail has their own code of ethics. You actually see it nearly posted on some doors, in some offices of that. We're going to deliver the mail through rain, snow, sleet, and hail. They have an ethics of not opening your mail. Does everybody follow it? No, but mostly the corporation or company is going to follow their code of ethics. You have to do it. As students, you need to follow your code of ethics. As you can see, honesty is good. We do not want to fail you because you did something dumb. Okay? So, next part, again, we're going back over various types of businesses. This is basically, we have manufacturing, which is companies that create or manufacture products to sell, and they use materials, labor, and other means of production. I like this, think of Ford or Apple. Ford and Apple. But these aren't really any company that makes a product that's going to have the inventory. This is what we're going to mostly focus on in these chapters is the manufacturing base, especially with material, labor, and overhead. Next part is service. Of course, these companies perform a service to a customer for revenue generation activities. Again, most of these are intangible items. So you're taking my knowledge right now as a student. That's intangible. I may give you some physical items, but me actually teaching you, that's a service. You can't just grab my teaching. The next one is merchandising. Companies that purchase and finish inventory to sell, so they take it from the manufacturer. Grocery stores are really big with this. Walmart, Amazon, so forth. Those are merchandising companies. Those two are really going to be shifted to financial. We really focused on those in financial, 2301. 2302 is more manufacturing again. So, next part with your notes, we have types of cost classification. Alright, so since this is basically the first chapter in managerial, even though it's chapter 14 in your books, this does have some definitions. We love definitions. Yay! Woo! Make sure you highlight, circle wherever the definitions are, because you know you're going to end up getting them. So, in this chapter, we're going to use a company called Rocky Mountain Bikes. And that sounds like a John Denver song. What is it? Rocky Mountain High? But it's a bicycle manufacturing company, and we're going to basically go through the types of costs the business can incur. So follow along with me as we take our bike ride through the Rocky Mountains. Take me home, country roads. Alright, so to facilitate, we basically are planning control decisions. And I like this little smiley face. It's a cute smiley face. And Rocky Mountain Bikes will classify the costs the following ways. Watch out for this. First one is variable and fixed costs. These are two key ones that we're going to go into quite a bit in chapters. One, variable costs are basically changes in the cost or the proportion of the cost in activity volumes. So, if the volume increase, so does the cost. So this is buying steel. I need more steel. So it's going to cost me more to buy more. Well, fixed cost does not change. No matter if I build 100 bikes or I build 2 bikes. No matter what, my fixed cost is still the same. If you want to take this to a term of algebra, you can. If you remember y equals mx plus b, which is linear equation. And I try to actually type this on here. I wish I can. But b, my y-intercept, are basically plus b, is basically my fixed cost. My slope is my variable cost. One changes, one does not. No matter how many products I have, it still be the same number. So we're going to get more in heavily debt and what types of things go into these costs. Right now, we just kind of want to get the variable definition. Okay. Next one is known as direct versus indirect. Okay. Direct costs. These are ones that we can actually physically trace to any product, process, department, or customer. So if somebody orders a custom lowrider bike, we can actually go, this frame went to this bike, went to this customer, and so forth and so on. Indirect costs. These costs are, of course, cannot be traced to any product, process, department, or customer. So with bikes, you need nuts and bolts. Are we going to literally trace hundreds of nuts and bolts to these bikes? No. So this is going to be known as an indirect cost. All three business types also have to track and sometimes I can't speak. Analyze these types of costs. However, Rocky Mountain Bikes will also track these kind of costs, and these are a little bit more difficult. I will tell you that. One is product cost. These are necessary to create or manufacture a product. So these consist of basically direct materials, direct labor, and manufacturing overhead. So again, looking up here, direct costs, direct materials means we can trace these materials to the products. Direct labor, again, we can trace. Even this manufacturing overhead, you can trace some of it, but mostly they're going to be indirect costs. But these are going to be capitalized as part of inventory on the balance sheet. So again, manufacturing does a lot more balance sheet stuff this time around. So we're going to get more into inventory and how it works. So basically, once the inventory is fully manufactured, so it's in work in process right now, we have to keep it on our balance sheet. Once it is sold, the cost will then be expensed to cost of goods sold on the income statement. Here are probably going to be the few journal entries that we're going to pretty much deal with in 2302 is basically how does these change. Okay. Period cost. Period costs are actually non-production costs. They're mostly known as general and administrative expenses. So these actually are linked to a time period rather than the manufactured products. So kind of figure that these are like almost indirect. Okay, they go over the overall business cost rather than specifically linked products. Few items here include sales staff. They're not linked to a product, they just want to sell. Maintenance workers' wages, they just want their janitorial, so no product's gonna have a janitorial thing unless it's Mr. Clean. You have advertising expenses, depreciation on corporate office furniture and expenses. Now, you need to watch out for this because this is on corporate office. If it's on the factory that is part of production, it's actually going to be a product cost. That's a nice little twist, okay? But there's mostly going to be known as general and administrative expenses. We will have selling expense. That's of course the sales staff, advertising. Those are normally sales expense. Advertising is the little twist one depending on what company you go to. Sometimes they put in selling, sometimes they put in general and administrative. I've seen it both. So, the next part right here, we're getting into basically what period and product costs are. Again, we have the big three. You're going to see these big three throughout this whole course. Direct labor, direct materials, and manufacturing overhead. They all go into the product. So, period costs are expenses not attached to the product. Again, selling costs to ever occur to deliver the finished good to customers, and any other non-manufacturing costs or administrative to support the administratives. So as long as you get these two to what they are, you're going to be cool. You're going to be good. But it does take a while. So here we go. We're going to use our Rocky Mountain bikes, basically explanation, to go into what would be direct materials and stuff for building a bike. Yay! Building a bike right here on Sandjack Radio. Yes. So, what are these products? So, again, they reflect anything in the manufacturing of a product. So, first off, direct materials. These are materials that are normally known as raw materials, and we actually deal with the costs associated with them. For Rocky Mountain, these could be including as tires, seats, other materials that are critical to the finished product. So, the frame, the handlebars, the seat, well, it actually says seat, but not the tassels. Sorry, tassels are probably not going to be essential or critical to the bike. Not even the basket. I mean, you may can argue, but some of those are not very critical. But for the type of bike, maybe we can swing that way. But it's really any material that's going to be critical to finish the product. We always use raw materials, and we're going to get into how to budget raw materials later on. Direct labor. Direct labor is any employee that uses a physical effort to convert the materials into finished products. So, this is any cost of salaries and wages, and they must be to the product. These are basically people that touch the product. If without them, we cannot produce. So these are your workers, your assembly line guys, your guys that are working the machine to actually create the bike. Those are going to be our direct labor. So again, labor costs for Rocky Mountain bikes will be wages of employees, again, that assemble the bike, as well as employees that buy paint, weld, and other forming activities. Yes, bikes get welded. Next one, manufacturing overhead, is basically all other costs that are not direct materials or direct labor. Pretty simple if we can figure out the first two. So, and I will warn you right here, Connect does take these two, and they kind of use another term also known as convertible. Basically convertible materials, convertible labor. So it will switch back and forth between chapters. I will keep reminding you once I see that basically means direct materials and direct labor. Alright, so again, manufacturing overhead, all other costs, these are not easily traced to any specific finished good. Again, these are kind of indirect, but they're still related in the production of the product. So for Rocky Mountain, this could include the maintenance of the factory, factory supervisors, factory utilities, factory equipment repair. You notice that thing that's going on here? Mostly if it's dealing with the factory rent, it's going to be mostly an overhead cost. Again, we can't trace them. They're indirect. So as long as they can't be traced, so material that is, again, like the nuts and bolts, the tassels, they are kind of indirect. So raw material that can be included and not a critical part right there in the note, so note right here, are considered indirect. Labor that is part of the manufacturing process but not specific to a product is also known as indirect labor. So factory supervisors are probably more indirect labor. They are not tied to anything. Okay? So there we go. There is a conversion cost. Conversion cost, prime cost. Again, these two are other ones. Again, basically McGraw-Hill likes to change it up with a few others, and we'll get into that later on in other chapters. So don't worry, if we see a new term, you know I'm going to explain it to y'all. Okay, so what we got is known as prime and conversion cost. Prime cost, just like prime rib, they're going to be the direct materials and direct labor. Conversion cost is basically manufacturing overhead and direct labor. So you do need to know the difference when we use those terms. We're not going to use them very much, but realize what two items go into that cost term. So, what is the flow of manufacturing activities and their associated costs? For manufacturing companies, raw materials are required. Additionally, labor is hired to help convert the raw materials. Then other indirect insignificant costs are there to finish the product and identify and prepare for manufacturing activities. So the cycle is this: we get the raw materials, we hire the people to create the item that we want, we have to have other costs, we have to have supervisors, we have to have a building. All this is part of it to basically identify and prepare for any kind of activity. So we're creating them. So in our actual things, we're going to have new terms. All these are inventory terms. One, while it's going through the process. being converted from raw materials to the finished product is going to be in accounts known as work in process. Every division will have a work in process part because we're going to have many divisions. It could be in painting one day, it could be in putting together, lots of little things. Once it's done, once the product is completely finished, it is going to go into what is known as finished goods. Once it's in finished goods, we are then able to sell it. And we're going to get into how we do the journal entry to sell and how does that work in a little bit. But keep an eye out when we use these terms. That's what it's basically going. Work in process is basically taking our raw materials, our direct labor. We're going to put those costs in work in process. Once they're all done, we move to finished goods. And this is basically our cost of goods sold. Okay, this is what's in finished goods. So, how are these various costs presented in financial statements? Again, balance sheet, it's going to be our raw materials, ending balance right there. So our inventory of raw materials, the inventory that's in work in process, and finished goods. So all these will be under inventory. So if we have a big company that manufacturers like Ford or Apple, Dell, they're going to have many of these accounts. You're going to have a lot of sub-accounts, so it's always good to know what they are. Then you got your income statement. Again, once the finished goods are sold, we get to capitalize the manufacturing costs as cost of goods sold. Period costs are of course expense as operating goes. So we don't really have to hold on to period cost. We only hold on to the cost to actually build the product, to make the finished good. Once we sell it, then we get to use the cost of goods. We actually basically recognize the expense that's related to the sale of that good. So of course we got this cool little graphic. I like this graphic because it starts right here. Year 2017 cost incurred. Here's our period. Here's our product. Product gets separated into inventory sold in that 2017, inventory not sold until year 2018. Here, period cost goes right here as operating expenses on our 2017 income statement. Inventory sold is known as cost of goods. The ones that are not sold stay on our balance sheet. Once they're sold in 2018, then they show up on the 2018 income statement as cost of goods. This is a neat little graphic if you just need a refresh to it, just to see how it goes. So, what is the cost of goods manufactured schedule? How do you calculate cost of goods manufactured? What is it used for? Oh wow, lots of questions. Let's make it very simple. It summarizes the various types of costs that were incurred in manufacturing process. Basically, was manufactured, the raw materials, the direct labor. We're going to take it and we're going to see why our production costs too high. If our budget was this, but they were much higher. It could be that materials cost more than what we predicted because somehow there was a shortage in, let's say, video games. The chip back in the 90s with Nintendo, the chips were hard to get, so manufacturing got high for any company that was non-Nintendo that wanted to be on the NES. So you want to watch out. Maybe that's it. Maybe labor got high, overhead, rent increase, stuff like this. We want to see what's gone on in between our budget. So we need to adjust the plans to compensate for these now higher costs. So what's going on soon is wages are getting increased. They increased like at the beginning of the year. And you notice that these companies that had these wages in certain states, they're going to increase the cost of food, or if it's a restaurant, onto the customer to help cover the cost of providing the new wages. That happens. Mostly they're should already know. But they're also going to find ways to lower the cost. Best thing is not to do unethical things by cutting corners. They're going to find just another company that they can get the materials just a little bit cheaper. Okay? So, the schedule actually looks kind of difficult, but we're going to break it down just so that it does make a little bit more sense in the way it is. So we have the 3-step process to get to cost of goods manufacturing. One is we're going to add up direct materials, direct labor, and the overhead that was used in production. This is known as total manufacturing cost. Next, we're going to add back the beginning work in process inventory. This gives us our total cost of work in process, and then you subtract the ending work in process inventory. This is known as cost of goods manufacturing. Okay, so what's basically was in at the beginning of the year to what has gone out. That will actually help us figure out the total cost, because this is our total cost for the year right now. And then once we subtract the ending, we actually know how much was actually made out and made to finished goods. Okay, so from there, we're going to look at basically income statement, cost of goods sold. To calculate this, we're going to start with the beginning finished goods inventory. So you're going to look at your finished good inventory. If it was like $500, you then going to add the cost of goods manufacturing. So whatever this one is, you're going to add that. Let's say it was like 600. So 500 plus 600 was 1100. Then subtract by ending finished goods. So again, 800 right there. So that will be about 300 in cost of goods sold. So things are right there. You just need to really go through these 3 steps. Mostly, we're always going to add the beginning. We're going to subtract the ending. If you remember that, we're going to be good. Okay? So, with that being said, and since this is a PDF, I really don't have to hide anything on y'all. We're going to use this example. Right here, we want to prepare a 2017 schedule of cost of goods manufacturing for Smith Co. based on the following production activities. 1. We have direct materials, direct labor, manufacturing overhead, and notice that we have these. Notice that it does say December 31st, 2016, December 31st, 2017. If we're looking at beginning, it's not going to change from December 31st, 2016 to January 1st, 2017. So this is going to be our ending balance. This is our beginning balances. These are our ending. So again, we're going to first calculate cost of goods manufacturing. So we need to add up these big heavy 3. Direct materials, direct labor, manufacturing overhead. Woo! Right there, there's our add. It's now 283,100. So no hard math going on here. Just gotta remember the formula. Next step, add the beginning. So beginning again is the December 31st, 2016 of 165. Add those, we have 448,100. Last step, we must subtract the ending balance. So December 31st, 2017 of work in process. We subtract, we get 217,600. Done, said, good. That is our cost of goods manufacturing. You have to keep this by itself till we work on the next part, which is cost of goods sold. So here comes cost of goods sold. So we're going to start with the beginning finished goods, and we're going to add our cost of goods of manufacturing. So again, going to 2016, 500, 600, boom, add the 217,000, should give us 718,200, and then we just subtract the ending. So again, the ending right here was December 2017, 170. Once we subtract that out, our cost of goods is 548,200. Okay. Go through these, change up the numbers just if you need to, so you can actually just start getting used to the steps. Okay. Believe me, this is going to be on your homework, so we'll get into that in a separate video so you can see how that actually works in problem situations. If you'd like to see it as a T account, here they are in T account form. Here's our beginning, our raw materials, wages, and overhead. They all go to work in process. Notice we add, here's the beginning, we add all three. We end up finding a total. We have our ending balance right here. So the missing, once we add all these together, minus the 230, should give us that 217,600. Of course, this is credit. Remember, finished goods, work in process, and our three other accounts right here, they are all going to be associated with mostly a debit balance for work in process. Work in process is usually always debit. So it's a debit, it's inventory, so it's going to be a debit for that naturally debit. Okay, so the 217,000, so if we made the journal entry right here, cost of goods manufacturing is basically our finished goods during the year. So we take that, we add it to our finished goods. So beginning plus this minus whatever our ending is to find out the difference. That ends up being our cost of goods sold. So we credit finished goods that amount. We will debit cost of goods sold. Okay. And the last little parts that we got going on to finish it up. One, some of the ratios that managerial accountants tend to use basically to assess what raw materials are. One is the raw materials inventory turnover. And that sounds like a recipe, but it's really not. Basically, how many times the company turns over or uses all of its product and raw materials during the year. We usually like a higher ratio. That means there's less materials that are sitting in the warehouse, not being used. Usually, you're going to see a higher ratio in something that's more perpetual in how they go with the flow just in time. So mostly customs will have a higher ratio because they're only going to order raw materials when they need to make something. So for us, the inventory turnover is raw materials used divided by average raw materials inventory. Best way to get average raw material inventory is take your beginning raw materials, add your ending, divide by 2. Boom. There we go. And then that will give us our turnover rate. The other thing is days sale and raw material inventory. Basically, we want to find out how long it takes us to make the product. So take the raw materials to be used. And it's going to determine if the raw material inventory is adequate to meet production demands. So a lower ratio is always preferred because it means it's staying in storage a lot less. So that's decreasing costs across the field. We don't have storage fees. We don't have to pay our inventory workers that much, well, a lot, because there's no inventory to actually for them to manage. Even transportation costs, the warehouse fees, all those, they will go out the window. So we always go and check this out just to make sure raw materials is constantly going out and seeing how long they actually wait. So to figure this out, we're going to take ending raw material inventory. We're going to divide it by the raw material that was actually used and times it by good old-fashioned 365. Once we did that, that gives us our days sale and raw material inventory. So if we have a high number, we probably need to look out and see what's going on. If we have a low number, we're pretty much happy because, again, that's saving costs across the board. Okay, and that is it for chapter 14. Hope y'all enjoyed, and I'll get back to y'all with the next video.